This is part 4 of topic 6, where I'm going to introduce multiple equity factors and foreign exchange factors in an international equity portfolio. So this is where we are with the notes. Section 4, VaR for international equity portfolios. So now we're introducing currency risk. I tend to prefer the term foreign exchange risk, but they're interchangeable, which is the uncertainty in the value of an investment due to fluctuations in exchange rates. So it always arises when you're trading international assets. In other words, the foreign currency of those assets is different. It's not the domestic currency. And I often abbreviate foreign exchange to FX, or some people call it Forex. So see all those terms: currency, foreign exchange, FX, Forex, even exchange rate risk, some people might call it. And who does it affect? Well, any exporters of products or services, so financial services firms that provide international advisory or M&A, or large banks, of course, they're going to be affected by foreign exchange risk. Anybody who is buying or selling assets in another country, so any investors like that, hedge funds obviously, asset managers do that frequently. Any multinational corporation will have expenses in different parts of the world because it's multinational, and so corporate treasury will have a big job with foreign exchange risk. And we're going to be looking at the risk factors specifically for an international stock portfolio. And we're considering a hedge fund in the UK, and the portfolio contains not just UK stocks, but also US and European stocks. So there's going to be 3 equity risk factors and 2 foreign exchange risk factors. The equity risk factors could be, well, it could be more than equity, 3. I mean, depending on whether you want to look at sector indices or so forth, but at least you'd need the FTSE 100, the S&P 500 and the Euro Stoxx 50. Those are the standard sort of broad market indices we use in these countries. There are others, of course, but those would be examples. And then you need, because the hedge fund is in the UK, you only need 2 foreign exchange risk factors. They are the US dollar sterling exchange rate and the sterling euro exchange rate. But of course, if the hedge fund were in Dubai or something, then there would be 3 foreign exchange risk factors, the same number as there are equity in this case. Now we have to look at foreign exchange betas. We've already looked at equity betas previously in this topic, and we use regression. Or equivalently, if in the single index model, the beta is just the correlation times the relative volatility, so we don't actually need to use the actual regression in that case. But for foreign exchange, we haven't got a portfolio like we have for the hedge fund has got maybe 50 UK stocks or 200 US stocks. It's not got the actual FTSE. So when the FTSE 100 increases by 1%, the beta shows how much the portfolio changes by, which isn't always 1%, unless it's an index tracker. Of course, then the beta would be 1. That's the aim of index trackers. But normally the beta is not 1. It can be bigger than 1, less than 1. It could even be negative. But with the foreign exchange rate, we've got 1 foreign exchange rate for each country. Okay, so there isn't a beta to really think about. Where would we do the regression, for example? What on? So consider the case where a UK hedge fund wants to buy £5 million worth of US stocks and £3 million worth of European stocks. Okay. Well, in order to buy those stocks, they must first convert GBP into USD, 5 million of it, and 3 million GBP needs to be converted into EUR. Okay, so we need to make those transactions first. Now, suppose that that's done and the hedge fund is ready to invest in these stocks now because it's got the local currency, but it doesn't even have to invest in those stocks. In fact, irrespective of what the stock prices do, it's now exposed to FX risk. And the hedge fund could make or lose money on these FX rates. So the percentage betas are always 1, and the nominal betas are the amount of your domestic currency needed to buy the stocks at the time that you make the investment. So the nominal betas would be 5 million and 3 million respectively. Here's a numerical illustration of why the percentage beta is always 1, and the dollar beta is the dollar amount invested in that country. And here I'm thinking about a dollar investor. So suppose the USD GBP FX rate is $1 equals 80 pence when a fund invests, say, 5 million. In other words, okay, so it's a UK fund. It invests 5 million sterling and it converts that sterling to 6.25 million at the exchange rate of 1 to 0.8. And now suppose that the US dollar rate strengthens by 12.5%. In other words, $1 US is now worth more than 80p. It's worth 0.8 times 1.125 because it's strengthened by 12.5%. In other words, it's worth 90p now. Now, even if the fund hadn't yet bought those stocks, that 5 million that it converted into $6.25 million will now convert back into £5.625 million. And what's the return it makes? Well, it's 5.625 minus 5 over 5, which is 12.5%. So that is matched 1 for 1. If the US strengthens by a certain amount, then the return the fund makes is exactly that amount. Or if it weakens, then the fund would lose money if the US dollar weakened, and it would be matched 1 for 1. In other words, the percentage FX beta is always 1. And the dollar beta is the dollar amount invested in that country. In this case, we're looking at pounds, but whenever, I use dollars as a ubiquitous term for the nominal. So let's have a look at an example of we're just looking at systematic VaR now. We considered the specific VaR earlier on in this topic, but now we're just looking at the systematic VaR. And the total systematic VaR now has 2 components, an equity component and a foreign exchange component. Here's a simple example. You've just got 1 equity risk factor and 1 foreign exchange risk factor. And suppose we're a US investor, we buy 2 million of shares in a portfolio of UK stocks, and the portfolio's equity beta is 1.5. So that's the percentage beta is 1.5. And now I've got some volatilities for the equity index and the exchange rate. They are 15% and 20%, and their correlation is 0.3. And the aim now is to calculate the 1% 10-day systematic VaR using the normal VaR model. And then we want to decompose this into FX and equity components and compare the sum of the FX VaR and the equity VaR with the total systematic VaR and comment on our results and express answers in both percentage and dollar terms. Okay, so let's start off with our risk factor mapping. So we do a regression of the equity returns. In this case, they're in the returns in US in sterling on the FTSE returns, and we've got a percentage beta of 1.5, and we ignore the idiosyncratic or specific part. So that's why I put a hat here on the Y. And then we add on X2, which is the return on the exchange rate. And the beta is 1, so I haven't written it in there. We've got some volatilities of 15% and 20%, and to convert them into 10-day standard deviations, because we want a 10-day VaR, we want a 1% 10-day VaR, we use the square root of time rule. So we have to scale down the 15% to something smaller by dividing by the square root of 25, because there are 25 10 days per annum. And the square root of 25 is 5. So we divide the volatilities by 5 to get 0.03 and 0.04 respectively. Now we take the variance of y hat equals 1.5 x1 plus x2, which gives us 1.5 squared times the variance of x1, which on the 10-day scale is 0.03 squared. And then we've got 1 squared, which I haven't written, times the variance of x2, which is 0.04 squared on the 10-day scale. And then we've got twice times the product of the betas, so we've got 2 times 1.5 times 1, times the covariance. And the covariance is the correlation times the product of the standard deviations. Correlation, of course, does not scale with anything. It's unitless. We never apply the square root of time rule to correlation. We end up with a result 0.00471 for the variance. And we have used percentage betas here. So our VaR will be expressed as a percentage of the portfolio value. If we'd used dollar betas, then we would have got the dollar VaR. Anyway, we use percentage betas in this case, and the VaR is the square root of 0.00471 times the 1% critical value, 2.3263, which gives 15.9571%. And then there's 2 million invested in this portfolio. So the 10-day systematic VaR in dollar terms is 319,142. Next, we need to decompose it into the total, into equity and FX components. And here we don't take into account that correlation of 0.3. So the equity percentage beta is 1.5. And so the 1% 10-day VaR is just 2.3263 for 1% times the beta times the market VaR, which in this case is just the 10-day standard deviation, 0.03. Actually, it's 1.5 times 2.3263 times, because it's beta times, and the other two terms, 2.3263 and 0.03, is the market VaR. So that gives 10.4646%. Multiplying it by 2 million gives us $209,371. And the FX percentage beta is 1, so we've just got the normal VaR formula, the 5 to the minus 1 term, which is 2.3263 times the 10-day standard deviation, which is 9.3054, and the corresponding VaR multiplied by 2 million is 186,108. So the sum of the VaRs is 395,479 in this case, if we add those two together. And it's greater than the total systematic VaR, which is 319,142, much greater because the correlation is quite low in this case, 0.3. So remember, the lower the correlation, the more the difference between, the more risk reduction from diversification that you will only see in the total VaR, which accounts for that correlation. The component VaRs don't account for the correlation between equity and FX. I'll go through the Excel file in the next video, I think, because there's quite a few things I want to cover, and I'll go on now to the solution to a more complex case now, where we've got a general number, say M, of equity risk factors. So you consider maybe a very large international portfolio with investments in M different countries, stocks all over the world. And these are returns or P&L. Remember, if you've got short positions, you should not be using returns. Long and short positions. If you had just short, then you could pretend it's long, just use the other tail, but that's another matter. So there are M equity indices, and assuming that the investor also has some, one of those risk factors is the domestic stock index, then we'd only have M minus one, we'd have one fewer foreign exchange rate as a risk factor. Okay, so if we take variances of this now, we can't express it using the summation form that we used before, because it's far too large. We'll have to use the matrix form. And we've come across this before, but with not such a large variance-covariance matrix or such a very large beta vector. So the betas are the coefficients in the risk factor mapping, which is a lot of proper betas, which we'll get from a regression, or set of regressions usually. And then a lot of ones, because these are in percentage form. And we can decompose that beta vector into two parts, an m-dimensional, m by 1 vector beta EQ, and a series of ones. And so, in fact, I should put primes inside as well here, but you understand what I mean. You've got one column vector of the betas for the equity factors, and you've got a column vector of ones here for the betas with respect to the foreign exchange rates. And that V is a big matrix. It's of dimension m plus m minus 1, so 2m minus 1 by 2m minus 1. So the next step is to partition this large matrix into 4. So you've got your top left m by m covariance matrix of equity risk factor returns, that's the VEQ. Then you've got your bottom right covariance matrix of the FX risk factor returns, which is dimension m minus 1 times m minus 1. I mean, it could be the same m, as I said, if you don't have any domestic stocks in your portfolio. And then you've got these possibly non-square matrices of covariances between the equity and FX risk factors on the other non-diagonal blocks. So we partition the matrix that way. And then if we imagine we're putting the beta prime V beta with this, and our beta is also partitioned as the beta equity part and the ones, we can actually isolate just the top left quarter and the bottom right quarter. Forget about the covariances between equity and FX. We're just going to pick out the equity component and the FX component as component VaRs, but the total VaR does include the equity FX covariances because it uses the whole of V. So the total systematic VaR uses that great big beta and the great big V. And again, assuming that returns are daily and normal, we'll use the normal model, and the H is there to scale as using the square root of time rule, and we scale it up for like 10 days. H would be 10 here, because we're assuming the returns are daily, and so our covariance matrix will be on the daily scale. And then the two component VaRs are very similar, but they just use those components of the beta and covariance matrix. And so those are the two standalone component VaRs, which don't account for the correlations between equity and FX risk factors. Now they account for correlations within the equity risk factors and correlations within the FX factors, but not the cross correlations, what we call the quanto correlations. These are ignored here. So here's an example. Suppose a US investor buys 2 million of shares in a portfolio of UK stocks with a beta of 1.5 and 3 million in US stocks with a beta of 2. I've put these in red so you can see where they are on the Excel spreadsheet. I'm not going to do this by hand. It's too difficult. Well, it's not too difficult. It'll just take a long time and it's much quicker in Excel. And then we've got volatilities as before, same as I had before. And suppose we now need to know the S&P 500 volatility as well. That's 10%. And then we need another correlation between the S&P 500 and FTSE returns, which is going to be 0.8, and another correlation between the S&P 500 and the exchange rate returns, which is going to be 0.5. And then we want to find a 1% 10-day systematic VaR in US dollars based on the normal VaR model, and then decompose it into the total systematic VaR for equity and the total FX VaR, those two components. So as I said, I will go through this Excel file in the next video, because otherwise this one's going to be too long. Final remarks on total systematic VaR disaggregation into component VaRs. Well, this disaggregation allows us to attribute VaR into these important components. How much risk is coming from the equity exposure? How much is coming from the foreign exchange exposure? And we could also disaggregate, for example, the total equity VaR and all the total FX VaR. We could decompose those total VaRs into component VaR for different countries. The total VaR takes account of diversification. And that, as we know already, it comes because the correlations are less than 1. So whether we use the total systematic into equity VaR and FX VaR components, or if we look at the total equity into different equity components, for example, we always have that the sum of the components is going to be greater than or equal to the total VaR, and it's only going to be equal when all the correlations are 1. So, for example, the equity VaR plus the FX VaR is greater than or equal to the total systematic VaR. And if we had, say, equity components such as US portfolio, UK portfolio, and European equities, then the sum of each one of those component VaRs would be greater than or equal to the total equity VaR. And again, you'd have to have perfect correlation everywhere for them to be equal. But there is actually a way you can disaggregate total VaR into marginal VaRs. And marginal VaR is difficult to calculate. It's much more difficult to calculate than component VaRs. And so I'm not going to go through that in this lecture. But what is marginal VaR? It's how much total systematic VaR changes if you make a small increment in your investment in one little bit of the portfolio. So a small increment in the exposure to a particular risk factor. All the other exposures are constant. So for example, you might bump up the amount of money just a little bit. Instead of $5 million, you might put $5.1 million, or a bit less than that, $5.01 million into the UK portfolio, and then you see how much VaR changes. So marginal VaR shows a risk factor's incremental contribution to the total systematic risk. And in this case, we have got that additivity. In other words, after weighting each marginal VaR by its risk factor sensitivity, by its beta, the total equity VaR, for example, it could be FX as well, but I'm doing equity here, will be the sum of the beta I times the marginal VaR of equity factor I. So that's it for this video. I'll see you in the next one.